There have been a ton of recent high-profile stock splits in the stock market this year. Upcoming stock splits in July include Google parent Alphabet with a 20-for-1 stock split, and GameStop, whose board of directors recently approved a 4-for-1 stock split. Other high-profile companies have already split their stock this year, like Amazon, Shopify, and Dexcom. Additional companies like Tesla have signaled that they plan to split their stock this year as well. With all of these major stock splits taking place, I wanted to highlight in this video 3 important things to know about stock splits and how they work. The first thing you should know is how stock splits work. It's really important to know that stock splits don't change the valuation of a company, only the share price and the total amount of shares that exist for the company. This is due to the mechanics of how a stock split works. When a company announces a stock split, everyone that owns shares of the stock on the issue date will have their total shares owned multiplied by a certain amount, but the share price will also be divided by that amount. Let's illustrate this concept with the idea of an apple pie. Let's say the pie is divided into 4 quarters, and each quarter of the pie is owned by a different person. If we decide to split every person's quarter of pie into 2 pieces, each person would now own 2 pieces of pie, but the size of each slice of pie they owned would be halved. The amount of the whole pie each person owns would still be 25% of the total pie. It would just be split into smaller slices, and they would have more of those slices. This is the basic mechanics of what takes place in a stock split. For example, if you own 1 share of a stock that is trading at $1,000 a share and the company announces a 10-for-1 stock split, when the stock split issue date occurs, you would then have 10 times the shares at 1/10 of the price. So you would now have 10 shares of the company, but each of the shares would be worth $100 now instead of the $1,000 at 1 share you originally had. This means that before and after the split, you own $1,000 worth of the company stock and have the same amount of ownership you did before. The only difference is after the stock split, the ratio changes so that you have more shares at a lower share price. This split math means that the company's market cap or valuation stays the same before and after the stock split. The second thing you should know is why companies split their stock in the first place. Since the market cap or valuation of a stock doesn't change when a company splits its stock, this brings up the question of why a company would even want to split their stock since nothing immediately changes for the company. There are a few reasons that a company might want to split its stock. The first reason is that a smaller share price makes it easier for smaller retail investors to buy a company's stock. High stock prices like Google parent Alphabet's nearly $2,400 a share can price smaller retail investors out of the market and make it so that they can't afford to buy shares. By splitting the stock, the company opens up its stock ownership to a new pool of potential investors. Another reason is that a smaller share price makes it more feasible for a company to get added to the Dow Jones Industrial Average Index. The Dow Jones Industrial Average Index is unique as a stock market index because it is stock price weighted instead of market cap weighted. Most indexes have higher ownership weighting for companies with higher market caps or valuations, so that the larger the company is, the more that the index holds of that company's stock. But the Dow Index is unique because it ignores market cap and has higher ownership weightings for stocks with higher stock prices, so that a company with a higher stock price has more stock owned in the index by the Dow. A consequence of this is that the Dow Index generally doesn't add companies to the index if their share price is in the thousands, since they would then have a massive weighting in the index. For context, United Health is the current largest holding in the Dow Index at nearly an 11% weighting, and it has a share price of around $520 at the moment. The next highest weighting is Goldman Sachs with just over a 6% weighting at around $295 a share. So if a stock's price gets too expensive, it's unlikely that they will be allowed into the Dow index, which gives companies an incentive to have lower share prices to gain entry into the index and larger institutional ownership. Another major reason for a company to split its stock is that publicly traded companies often give shares of their own stock as compensation for employees, as an incentive for the employees to work for the company. But a large share price can make it difficult for the company to award stock to employees and hard for employees to sell that stock. If each share of a company is worth thousands of dollars, it forces companies to award stock compensation in large dollar increments for each share unless they use fractional shares. It also makes it difficult for employees to sell their stock in smaller amounts, since for each share they sell, they are selling thousands of dollars worth of stock instead of smaller increments with each share, which would give them more flexibility with the dollar amount they want to sell. Because of this, smaller stock prices are easier to use for employee stock-based compensation programs, which benefits the company. Since stock splits also increase the amount of existing shares in the company and lower the share price, it also benefits by making the stock more liquid in the stock market, since there are more shares to trade between parties. This can reduce spreads between the market bid and ask prices and make it easier and more efficient to trade the company's stock. The third point you should know is whether it's a good idea to buy a stock before it splits. In recent years, people have sometimes thought that it's a good idea to buy a company's stock before the split, with the expectation that the share price will rise going into the split issue date. While there are instances of this happening, according to Schaefer's Investment Research's data on 190 stock splits going back to 2010, they say, quote, "Stocks that split underperformed in the short term and do not significantly beat the market in the longer term. In the 2 weeks immediately following a split, the stocks averaged a loss of 0.43%, with only 43% of the returns beating the S&P 500, unquote. This makes sense because stock splits don't change anything fundamentally about the company. The company's market cap or valuation is the same both pre-split and post-split, and the company's business is the same before and after. So there really isn't a fundamental reason to buy the company because of a stock split announcement. If you didn't think a company was a good investment before they announced a stock split, you really shouldn't think it's a good investment after the stock split, because nothing about the actual company has fundamentally changed. So those are the main 3 points that I think are important to note about stock splits. Let me know in the comments below what you think about all of the recent stock split announcements, and be sure to like the video and subscribe to the channel for more finance content and news. Thanks.